studying your last two. I swim with tea when they turned in. The staring out to mute and can lend a pole that some kid died.
Let's now look at another common type of investment income: capital gains. Unlike interest income, a capital gain is not earned every year. It arises only when a capital asset is actually sold. Imagine that a corporation has accumulated surplus cash from its business operations. Instead of leaving that money idle, the corporation decides to invest it in assets, such as shares of publicly traded companies, mutual funds, real estate, or other long-term capital investments. Over time, the value of these investments may increase. For example, the share price may rise, the value of a mutual fund may grow, or a piece of investment property may appreciate in value. However, it's important to understand that simply increasing in value does not create a capital gain for tax purposes. As long as the corporation continues to own the investment, the gain is considered unrealized and no capital gain is recognized. A capital gain occurs only when the investment is sold. For example, suppose the corporation purchases an investment for $50,000. Several years later, it sells that investment for $70,000. The difference between the selling price and the original cost is $20,000, and this amount represents the corporation's capital gain. In simple terms, the calculation is straightforward. You take the selling price and subtract the adjusted cost base, often referred to as the ACB. If the result is positive, the corporation has realized a capital gain. One of the key ideas to remember is that capital gains are tied to the sale of capital investments, not to temporary changes in market value. An investment can increase in value for many years, but until it is actually sold, there is generally no taxable capital gain to report. This distinction is very important because Canadian tax rules treat capital gains differently from interest income. As we'll see in the next section, only part of a capital gain is included in taxable income, making capital gains one of the most tax-efficient forms of investment income for a corporation. One of the biggest advantages of capital gains is that they receive more favorable tax treatment than interest income. The reason is simple. Not all of a capital gain is taxable. Let's continue with our example. Suppose a corporation sells an investment and realizes a capital gain of $20,000. Unlike interest income, where the entire amount is included in taxable income, a capital gain is divided into two separate portions. The first portion is the non-taxable portion. Under the current Canadian tax rules, this amount is generally not included in taxable income. Instead, it is added to a special tax account known as the capital dividend account, or CDA. The capital dividend account is important because it allows the corporation, subject to the applicable rules, to pay this amount to its shareholders as a capital dividend, which can generally be received tax-free. The second portion is the taxable capital gain. This is the part that is included in the corporation's taxable income and is subject to corporate tax. So, instead of taxing the entire capital gain, the Canadian tax system taxes only the taxable portion. This is what makes capital gains considerably more tax efficient than interest income. A simple way to remember this concept is to think of a capital gain being split into two buckets. The first bucket contains the non-taxable portion, which flows into the capital dividend account. The second bucket contains the taxable portion, which becomes part of the corporation's taxable income and is subject to corporate tax. This is a major difference from interest income. Interest income is fully taxable, meaning every dollar is included in taxable income. Capital gains, however, receive preferential tax treatment because only the taxable portion is included in the corporate tax calculation. At this stage, you don't need to memorize the exact percentages or detailed calculations. The key idea is to understand the overall concept. Whenever a corporation realizes a capital gain, remember that it is split into a non-taxable portion and a taxable portion. The non-taxable portion may eventually be distributed to shareholders through the capital dividend account, while only the taxable portion is subject to corporate income tax. This preferential treatment is one of the reasons why capital gains are often considered one of the most tax-efficient forms of investment income in Canada. Let's now look at the opposite situation. What happens when a corporation sells an investment for less than it originally paid? In that case, instead of a capital gain, the corporation realizes a capital loss. Suppose a corporation purchased an investment for $50,000. Later, market conditions change and the investment is sold for only $35,000. The corporation has now realized a capital loss of $15,000. At first, you might think that this loss can be deducted against any type of income, such as interest income or business income. However, the Canadian tax rules do not work that way. Capital losses have their own special rules. The primary purpose of a capital loss is to offset taxable capital gains. In other words, if the corporation has taxable capital gains from other investments, those gains can generally be reduced by applying available capital losses. Think of it this way. A capital gain increases taxable capital gains, while a capital loss reduces taxable capital gains. The two are designed to work together. What a capital loss generally cannot do is reduce other types of income. For example, it cannot normally be used to reduce interest income earned from a bank account or GIC. It also cannot generally be used to reduce active business income. This is an important distinction because different types of income follow different tax rules. Interest income is fully taxable under one set of rules, while capital gains and capital losses operate under a separate system. A simple memory trick is this: gains offset gains, and losses offset gains. In other words, capital losses are generally used against taxable capital gains, not against interest income or other ordinary sources of income. As a tax preparer, this is one of the key concepts to remember. Whenever you see a capital loss, your first question should be, does the corporation have taxable capital gains that this loss can offset? The overall takeaway from this section is that capital gains and capital losses form their own unique category of investment income. Capital gains receive preferential tax treatment because only the taxable portion is included in income, while capital losses are generally deductible only against taxable capital gains. Understanding this relationship will make it much easier to apply the corporate tax rules correctly when preparing Canadian corporate tax returns.